Hello, and welcome to another Cidel conversation. Today, we'll address some key issues about investing in a rising interest rate environment. It can be a source of anxiety for investors as to what to do in a portfolio as rates rise. My name is James Porter. I lead the Cidel Canadian Private Wealth team and our institutional client business, joined by Charles Lannon, Cidel's head of equities. So we'll just jump right into things today on this podcast. And Charles, interest rates are rising around the world. Should investors be concerned?
No, not necessarily. And it's important to recognize that rates are going up for two reasons. The first reason is very much a good news reason, which is that the economy continues to rebound from the depths of the pandemic. We're expecting global growth in and around 4.4% this year. And to give you some context, anything over 4% is generally speaking quite decent. The job market, not just in the United States, but in many European countries, is quite tight. And that is very good for the economy. It's very good for corporate earnings growth. It's tough for corporate earnings to go down when GDP growth globally is 4.4% in real terms. The second reason, however, why rates are going up is a bad news reason, and that's inflation. Many inflation figures, not just in the US, but in Europe and even in Japan, are at multi-decade highs. And inflation is problematic in that it really reduces consumer confidence. And in very short order, it can actually lead to demand destruction. And right now in the equity market, at the start of 2022, there has been a fearful narrative on some days, especially on some of the volatile down days we've had, that the central banks will hike interest rates too quickly. And instead of merely cooling off the economy, they will substantially clip its growth rate. And that's a fear that's out there in the markets right now.
I understand. Thank you. I know we've covered inflation in a couple of different ways in recent talks. So I'll move on a little bit and cut to the chase with what we want to cover today. And that's, do we think investors can still enjoy decent returns this year, years to come, during just in general terms when rates are tightening?
Absolutely. One of the key points we wanted to make in this podcast is that despite the fact that sometimes the media portrays interest rates as being absolutely terminal for stock market returns, that's not very much the case. Having said that, it's quite reasonable to expect that the composition of stock market leadership could change pretty significantly in coming years. And what we mean by that is since the global financial crisis of 2008 and 2009, US equities have absolutely trounced all other geographic cohorts, be it emerging markets or Canada or Europe or developed Asia. And relatedly, technology stocks, which are a much larger part of the US stock market. Formally, they're about 20% of the S&P 500, but when you start to add in companies like Amazon and Google and Tesla, which these days are actually not classified as technology stocks, that ratio is closer to 30%. In most other stock markets, technology is only around 10% or thereabouts of the benchmark. And when you look back historically, we've had 8 rate tightening cycles now since March of 1971 in the United States. US equities have been the worst performing major geographic cohort in 4 of those 8 rate tightening cycles. It's either been emerging market stocks or Canadian stocks or what's called EFI, which is European and Asian stocks that have led the charge. And given that we start this rate tightening cycle with a backdrop where US equities are expensive relative to their history and non-US equities typically are not, it wouldn't surprise us in the slightest if non-US equities do a bit better than US equities in the coming years.
Well, you've given us a good overview of geographical sectors. What about some industrial sectors? Is there anything you would avoid, stay away from, look towards?
Yeah, the market action we've seen in the last 8 weeks has really opened up the opportunity set for us. So had we been having this conversation before the holiday season, we probably would have flagged technology as being a bit of a troubling area. But so many high growth tech names are off so substantially since early December, anywhere from 25 to 50%, that they're no longer necessarily priced for perfection. They might not necessarily be right where we'd like from a valuation standpoint, but a lot of that valuation headwind we think has really come off the boil. And then on the flip side, many cyclical stocks, so stocks in the, say, the natural resources sector or in the financial services sector, they've had an absolutely fantastic run over the past 8 weeks, and really, quite frankly, since the announcement of the vaccines in 2020, that they're potentially getting towards the upper end of their valuation range. In terms of other sectors that we think stand out, some of them will still be reasonably vulnerable to inflationary pressures here over the near term. Consumer stocks very much are in that camp. We do like healthcare in our global equity and our international, which is to say global without the United States portfolio. We've had a large overweight there for some time. And these are businesses that do have a lot of pricing power and are able to grow their revenues in a variety of economic circumstances. If the economy is strong, they'll grow them quite strongly, but if the economy is weaker, they'll still be able to grow their businesses. So healthcare is a very, very rich hunting ground. It has been for us for a good few years, and we expect that'll be the case going forward as well.
Helpful, thank you. So how are you and the team positioning portfolios for the balance of the cycle? So looking ahead this coming year, the rest of the year, into next year, what specifics are you looking at in terms of building the portfolios?
Sure. So when we pick stocks and when we construct the portfolios, it's always on an expectation of a 2 to 5 year time horizon that we're looking forward. And we're always looking to construct the portfolios to generate strong risk-adjusted returns given the opportunity set that the market's offered up. So I just mentioned that there's been a big sell-off in many of these higher growth tech names. So those, I'd say really for the first time in 3 calendar years, we're taking a very serious look at some of those names. We've already started to build a couple of positions. It wouldn't surprise me if that continues going forward. And then by the same token, as I mentioned, some of the more cyclical parts of the market that have had a great run, really for 6 quarters now, a year and a half, we've started to lighten up there a little bit. But big picture, the recent speed wobble we've had in US equities and global equities in January, where markets were off about 5% in US dollar terms, has really opened up the opportunity set for us. So while we wouldn't be surprised if we continue to see some turbulence, especially in the first half of this year, we are reasonably optimistic that we can continue to do good work and grow client capital over that 2 to 5 year time horizon.
Well, Charles, thanks very much. We've covered a lot of ground in the past few minutes. Very much appreciated. To all of you out there, thank you very much for listening, and don't hesitate to contact your wealth consultant to learn a bit more or to carry on this conversation. Thank you.
This podcast is not a recommendation, offer, or solicitation and cannot be relied upon as investment advice. Listeners should not use this podcast as a sole basis for any investment, financial planning, tax, or other decisions. The information presented today has been compiled from sources that are believed to be reliable. However, no representation is made as to its accuracy or completeness. All opinions expressed herein are based on information available at the time of publishing and are subject to change without notice.